risk, public records, no derogatory public records, having public records, and then inquiries, full inquiries, so a lot of recent inquiries with open credit. Let's see, these kind of all talk to the same points. Long term, property type, it's a good one to see property type. Of less risk, we're looking at 1 unit, detached properties. A little bit more risk, we're looking at attached condos, co-ops, 2 units. Of greater risk, we're looking at 3 to 4 unit homes. The riskiest we're seeing is manufactured homes. The rest kind of makes sense as you go along. All right. So the impact of DU 7.0, one, it's going to look different than what you've seen on cases that you submitted before. Again, it's reflecting our commitment to make sure that the loans that are being originated are originated to try to keep people in homes. Of course, as I mentioned earlier, you're likely to see a decrease in your approved or expanded approval recommendations. At this point in time, you've been seeing it for a few months. You can kind of see where the ship is going. Some loans that might have been approved eligible are now EA1. Some loans that are EA2 or EA3 are no longer approvable. You've also seen some that were EA1 get approved. So it's an overall change in credit philosophy that you're seeing with the new version. Any question on the DU piece of it before I move into loss mitigation? All right. This will take me 1 second. All right. Loss mitigation tools, and really the purpose of going through this is so you have an understanding of what kind of options are out there for consumers, for your clients, for your borrowers, to help keep them in their home if they do start going delinquent. So what we're looking at right now, and we've been seeing it on the news, it's obviously affecting my company, it's affecting your business, it's affecting the whole market, it's affecting values across the country. As we're seeing, foreclosures are at a historic high. We're seeing over 2.5 million delinquent mortgages at the end of 2007. 8.8 homes in the United States, the borrowers are upside down. That means their home is not worth as much as the mortgages that they have on the property. And 1.8 million of these hybrid ARMs that are originated in 2005 and 2006, those have been resetting and will continue to reset into next year. So when foreclosure happens, it drives a lot of the things that we're seeing every day on the news now. We're seeing homeowners lose their home. We're seeing their credit get ruined. There's that stigma of, okay, I got foreclosed upon. That stigma also would influence them, if they did recover, their ability to get a new home. Oh, we got a spider.
You get a spider.
You get the spider on camera too. For communities, there's a high cost as well. That's just for the consumer. For the communities, depressed home values we're starting to see. For the communities are losing their property taxes revenue that they would have generated that pays for their fire departments, for their police departments. And then also there's a high cost of servicers, mortgage insurance companies, and investors as a whole. We have launched our homestay initiative. For those of you that heard me talk a little bit about homestay when I was out last month, our homestay initiative is our commitment to help people stay in homes. It's what we've done with Desktop Underwriter, how we tweak that. It's what we're doing in terms of the loss mitigation efforts that I'm going to talk to you about. It's what we're doing with Hope Now. That's a nonprofit organization, a national nonprofit that helps keep people in homes. It's a number that if you do run into, your consumers do run into this issue, I'm going to have the phone number at the end. You can give them that number as a way to start seeking help. We've been giving grants to nonprofits to support their efforts in keeping people in homes. And it's also been a restatement in the products that Fannie Mae has to offer that could help people who might be in those hybrid ARMs, who just needs a better situation, needs to refinance out of their higher interest rate or whatever they need to do. So our loss mitigation strategies. Let's see. Acronyms. We love acronyms at Fannie Mae, and we came up with yet another one. This is what we ask servicers to think about when they're working with consumers. This is what we ask nonprofits to think about when they're counseling somebody who might be in foreclosure. RAMPD, RAMPed. It stands for our different loss mitigation tools and the hierarchy that they should be thought of when you're using them. R being establishing a repayment plan. There's an issue in affordability where that borrower can't meet their payment. Maybe they fell a couple months behind. Repayment plans can be structured in different ways. One, they can do like a permanent interest rate reduction for that borrower. Two, they can take a mortgage arrearages, tack them onto the back of the loan and recast their loan. There's different ways that servicers can establish a repayment plan. The next is a new tool that we just came out with to help address the foreclosure problem in the country. That's our Home Saver Advance. I'm going to talk in a lot more detail about Home Saver Advance when we get to that slide. It's actually a very neat tool that we're seeing a lot of traction in the marketplace with Home Saver Advance. Next, modification, actually modifying that mortgage note. Instead of like a temporary interest rate relief, now you have more of a permanent interest rate relief. And many times that's something that needs to be recorded because you're actually changing the terms that that borrower originally signed up for. These are the three that help keep people in homes. And then the next step to avoid foreclosure are things where that consumer does end up losing that home. That would be a pre-foreclosure or short sale, and then also a deed in lieu. All these are options to keep consumers out of foreclosure. Again, the top three to help keep them in the homes. The last two are what we see are your last chances before actual foreclosure.
Do you have any stats or any benchmarks as to what percentage of borrowers who have applied to do one of the first three have success with their list?
Not yet. The Home Saver Advance is really new. Typically, they kind of rank like you're seeing here. A higher percentage is going to be repayment plan. As they get down to the deed in lieu, they're pretty much going to rank the percentages as they fall, but the actual numbers I do not have. The Home Saver Advance, again, is real new, so we don't have a lot of figures on how that's working well. All right. So again, the three options that keep people in their homes are going to be the repayment plan, the Home Saver Advance, and modifying that loan. With the repayment plan, this is where you're going to have your borrowers going to make incremental payments on top of their regular payments to get caught up. This is available if a borrower, to all borrowers, but if a borrower is more than 3 months delinquent, that's when it has to be a documented and recorded repayment plan.
Going to count against them?
At this point in time, yes, because your borrower's already late. They're probably 2 months delinquent, 2 to 3 months delinquent before these plans start kicking in. Basically, most of these options, with the exception of Home Saver Advance, kick in as soon as the borrower becomes seriously delinquent, which is 90 days or more past due. But a repayment plan can be established, and I'll talk about that, I think on the next slide, the timing of that. Question?
John, how does Fannie Mae feel about, for example, I run into a couple borrowers that have done these loan modifications, and they've got a series of late payments, right? But they've got a ton of equity in their house, maybe the job downside or something like that. What are the chances of, having some flexibility with, the late payments kill their credit score, so if they were able to have a family member or something like that, maybe refinance the property or something like that and pay that debt off, what are the chances of Fannie Mae kind of working with something like that to help people?
In terms of a new property or refinance?
Refinancing, because a lot of people have equity in their homes, but with all these late payments from
it's not going to look good. Again, because we're looking harder at mortgage delinquencies than we were in the past. So if we have 2 mortgage delinquencies in the last 6 months.
But doesn't Fannie Mae care about being able to make up for that loss, for that past due amount?
We do, and that's when these options come into play. So if they're already in the home and they're delinquent, instead of refinancing to try to fix the arrearage or pay the property taxes, some of these tools could possibly help. When I get to Home Saver Advance, we'll talk about your question again.